Picture this. It's a chilly November morning in Berlin. The radiators hum, coffee brews, and somewhere in the background, the financial nerve center of Europe is breathing a collective sigh of relief. Gas prices, which once threatened to bring the continent to its knees, have dipped to levels not seen in nearly a year. Some headlines even crow about Europe dodging the ultimate energy bullet. But is this calm just a deceptive lull before the next storm? Just months ago, European households and industries panicked as gas prices soared through the roof, pushing inflation higher and sending shockwaves from Paris to Prague. Many feared a return to the dark days of energy rationing, factory slowdowns, and skyrocketing utility bills. Yet now, on the surface at least, things seem manageable. The question is, for how long? The truth is far more complicated and far more precarious than today's relieved exhale might suggest. Underneath the veneer of stability lies a fragile balance, one that could shatter with a single geopolitical shakeup or a surge in demand from across the globe. If you're wondering why Europe's gas drama is far from over, you're about to find out. Let's rewind the clock a bit. Just a few years ago, European natural gas markets operated in a world that, while occasionally turbulent, felt relatively predictable. Prices hung comfortably at levels considered normal, before COVID-19 crashed economies and Russia's invasion of Ukraine upended the continent's entire energy playbook. The bedrock assumption was that Russian pipeline gas would continue to flow, keeping the lights on in German factories and the heat running in Spanish apartments. Then, almost overnight, everything changed. As Russia cut supply routes and the world scrambled for alternatives, Europe was thrust into an energy crisis of historic proportions. Suddenly, the continent faced a triple threat: spiraling prices, the urgent need to secure new suppliers, and consumers confronting unprecedented cost of living pressures. A wave of emergency measures swept across the EU. Governments imposed price caps, subsidized households, and pushed for voluntary consumption cuts. The sense of urgency was palpable. Energy efficiency, so often just a buzzword, became a matter of survival. But the world of commodity trading is anything but static. Fast forward to this year. A weaker-than-expected demand in China, the world's largest emerging gas consumer, provided a lucky break. LNG, liquefied natural gas, cargoes that might have sailed to Shanghai or Shenzhen instead, found their way to Europe. Coupled with a milder winter, the continent managed to fill its vast storage caverns to a record-breaking 95% capacity by November. The pressure valve opened and prices plummeted. The TTF, Europe's key gas benchmark, dropped to around 32 to 37 megawatt in May, down from panic highs well above $55 megawatt just 3 months earlier. For a brief moment, it looked as though Europe was in the clear. But history warns against short memories. Gas prices, even at today's levels, remain roughly double what Europeans paid in the relatively calm years before COVID and the war in Ukraine. If you factor in inflation, they're closer to normal, but only just. Experts like Gianluigi Mandruzzato from EFG International note, barring new shocks, European natural gas prices should decline but only gradually, as sustained imports will be needed to rebuild inventories. That warning isn't merely academic. The end of Russian gas flows via Ukraine on January 1, 2025, slashed pipeline inflows to the EU by about 10%. Norway has stepped up, providing half of all pipeline gas in 2024, but the gaps are plugged with LNG, a market notorious for price swings and global competition. To give you a sense of scale, LNG now makes up about 40% of the EU's gas supply, almost double its share from just 4 years ago. The United States alone accounts for 45% of all European LNG imports. Meanwhile, domestic EU gas production, despite edging up 7% late last year, remains a shadow of its former self. But as dependency on global cargoes grows, so does exposure to risk. The EU's spot market LNG trades have exploded, crossing 550 deals in 2024. According to Acer, the EU's energy regulator, the EU's reliance on spot LNG to shore up gas supplies is increasing U.S. benchmark Henry Hub's influence on the regional market. In other words, the price Europeans pay for gas is now more closely linked to American market forces than ever before. This shift is a double-edged sword. On one hand, it brings diversity, no more singular reliance on Russia. On the other, it leaves Europe exposed to events far beyond its borders: a cold snap in Boston, a hurricane in the Gulf of Mexico, or a sudden economic rebound in Asia could send prices rocketing. And let's not forget China, a silent player with outsized influence. In the words of Anatol Fagin, from U.S. LNG giant Cheniere Energy, China's commitment to natural gas appears unwavering, and we fully expect China to remain one of three main nodes of LNG demand growth. If Chinese factories roar back to life, those ships will change course, and European buyers will find themselves in a bidding war they may not win. Behind the price tickers and supply routes lies another layer: storage and consumption patterns. In 2024, the EU hit a milestone by filling storage to 95%. This buffer helped Europe weather the worst. But storage is no guarantee of safety. According to projections, European gas inventories could drop to as low as 35 to 40% of capacity by late winter, a dangerously thin margin if demand spikes or supply falters. Meanwhile, the consumption story is mixed. Yes, total EU gas consumption is projected to fall 4% in 2024, continuing a remarkable 23% plunge since 2021 as businesses and households scramble for alternatives. But Q4 of 2024 actually saw an 8% year-on-year increase in demand, hinting at a possible rebound as economies adapt and energy prices soften. This volatility is not just an economic concern, but a political one. As Gaurav Sharma of Oilholics Synonymous observes, Europe has taken its energy destiny back into its own hands, but at a cost to productivity. Subsidies and energy-saving mandates have shielded consumers, but they've also slowed growth and forced tough choices for governments already juggling inflation and social unrest. A Bank of Spain analysis warns that a natural gas price shock could add nearly 0.5% to Eurozone inflation in late 2025, a reminder that these swings are felt in every grocery store and at every gas stove. So, where does this leave us? The EU is sprinting to diversify its energy mix: new pipelines, fresh LNG contracts, deals with Norway, ambitious targets for renewables, and investments in alternatives like biomethane and hydrogen. Energy Commissioner Kadri Simpson sums up the mantra: "We enter this winter with a healthy level of gas and storage across Europe, diversified energy supplies, and a higher share of renewable energies." But experts caution that the picture is far from rosy. The market will need to see very robust storage builds continue beyond just a few weeks before they pull some of the risk premium out of forward pricing, says Blake Owen of Pinebrook Energy Advisors. In other words, the momentary calm is masking deep-seated anxieties. The market is on a knife's edge, and traders, policymakers, and everyday consumers know it. Imagine two possible futures. In one, surging Chinese demand or a supply disruption, perhaps caused by war, a new Cold War, or weather extremes, sends prices spiraling past $100 more. Factories slow, protests erupt, and inflation climbs again. In another, Europe pivots sharply to renewables, slashing gas demand by up to 30%. Prices moderate, the continent breathes easier, and the world hails a green energy revolution. Reality will likely land somewhere in between. But as we head into another winter, the fate of Europe's energy security and economy hangs in the balance. Will the next price shock be averted, or is Europe simply holding its breath, waiting for the next crisis to reveal the true cost of its fragile gas lifeline? The answer may rest not in Brussels or Berlin, but in the shifting tides of global demand, the geopolitical chessboard, and the relentless pressure to adapt fast. What happens when the world's energy giants clash over the same cargoes? How far is Europe willing to go to secure its future, and at what price? In the next part, we'll dig deeper. What are the hidden risks in Europe's new energy order? Which countries are most exposed, and what moves are being made in boardrooms and war rooms to shape the continent's energy destiny? As we turn the page from this fleeting moment of relative calm, it's crucial to look deeper. Beneath Europe's surface stability lie tremors that could set off the next big shock. The question isn't just if another crisis will happen, but how, and who will be hit hardest when it does. Let's start by zooming in on the countries most exposed to these hidden risks. Some nations, like Germany, Italy, and Austria, still depend heavily on imported gas to power their industries and heat their homes. Their progress in diversification has been impressive, yet not complete. Last winter, Germany scrambled to open new LNG terminals on the North Sea coast, a feat few thought possible in such a time frame. But it's not just about infrastructure. It's about where the molecules come from and at what price. Now, with as much as 40% of the EU's gas arriving as LNG, mostly on the spot market, Germany's so-called energy hub status feels more precarious than ever. At the same time, countries like Hungary and Slovakia, long reliant on pipeline gas from Russia, find it harder and more expensive to access alternatives. These nations face steeper bills and greater risk if another squeeze occurs on the global market. Southern Europe, think Italy, Spain, and Greece, has fared better thanks to connections with North African suppliers and flexible LNG regasification. But even these lifelines come with their own geopolitical fragility. So, what's lurking on the horizon? Experts warn that Europe's gas stability, for now, rests on three shaky pillars: weak demand from China, unseasonably full gas storages, and the absence of new geopolitical shocks. But as Anatol Fagin of Cheniere Energy points out, China's commitment to natural gas appears unwavering. We fully expect China to remain one of three main nodes of LNG demand growth. Any sudden surge in Chinese industrial activity could see LNG cargoes diverted from Europe almost overnight, sending prices rocketing. Then there's the matter of gas storage. Yes, European facilities hit over 95% full at the start of winter, but much of that gas was bought at premium prices. And as storage draws down, rebuilding inventories for next winter will require aggressive purchasing at whatever price the market demands. Blake Owen from Pinebrook Energy Advisors puts it bluntly: the market will need to see very robust storage builds continue beyond just a few weeks before they pull some of the risk premium out of forward pricing. A third risk, less talked about but equally decisive, is Europe's growing reliance on LNG spot markets. This shift has tethered European prices to global benchmarks, especially the US's Henry Hub, making the continent more vulnerable to distant events: hurricanes in the Gulf of Mexico, strikes at Australian export terminals, or diplomatic tensions in the South China Sea. And overlaying all of this is good old geopolitics. What if tensions boil over around existing pipelines from Norway? What if instability grows in North Africa or the US changes its export policy? These scenarios could quickly choke off supply, and with Russian pipeline gas now almost entirely gone, Europe's safety net is thinner than ever. Let's play out two possible futures. In the first, Europe's bet on renewables pays off. Wind and solar provide a growing share of the grid, backed by flexible storage and smarter grid management. Domestic gas production edges up, and alternative molecules like biomethane and hydrogen start to flow. LNG reliance stabilizes and prices gradually cool toward 30-40 pounds per megawatt hour by 2027, as projected by EFG International. The continent weathers market shocks with less drama, and the gas crisis slowly fades into history. But in the second scenario, things unravel. China revs up post-pandemic growth, hoovering up LNG cargoes. Norway or another supplier suffers unexpected outages, or geopolitical tensions block deliveries. Spot prices spike above $100 more, as seen in recent years. Governments scramble again, rationing gas, bailing out utilities, and watching inflation ripple through food and industry. A Bank of Spain analysis warns that a fresh natural gas price shock could inflate Eurozone inflation by almost 0.5% in the second half of 2025 alone. What about the ordinary consumer? Even with prices currently lower than last year, energy bills across Europe are still uncomfortably high, often double pre-pandemic levels. And volatility means price spikes can return at any time. As Gianluigi Mandruzzato from EFG International notes, barring new shocks, European natural gas prices should decline, but only gradually, as sustained imports will be needed to rebuild inventories. For business leaders and policymakers, these scenarios are more than academic. Last winter, governments poured billions into subsidies and public communications to prevent panic and keep the lights on. But these measures can't be repeated indefinitely. The real challenge is to make structural changes, boosting efficiency, speeding up renewable deployments, building flexible gas infrastructure that can one day be repurposed for hydrogen or new fuels. So, what practical lessons can we take from all this, as ordinary viewers trying to make sense of Europe's energy crossroads? First, expect volatility to be the new normal. Gone are the days of cheap, stable gas locked in by long-term pipeline deals. Prices will swing with the whims of global demand and supply shocks. For consumers, this means it's more important than ever to pay attention to your own energy use. Investing in insulation, smarter thermostats, or even small-scale solar can buffer against high bills when another crunch inevitably comes. If you're a business owner, large or small, hedging strategies and flexible contracts become essential. The lesson from the past two winters is clear. Those who could shift operations, lock in prices ahead of time, or diversify energy sources fared far better than those who waited and hoped for the best. For investors, Europe's energy transformation is a story of both risk and opportunity. Massive investments are flowing into grid upgrades, LNG terminals, and renewable power plants. Green hydrogen, biomethane, and homegrown technologies are no longer science projects, but are moving closer to commercial reality. The big winners will be those who spot which solutions truly scale and which regions are best positioned to benefit from the transition. Finally, for anyone watching policymaking, there's an urgent call for smarter, faster reforms. The EU's ambitious push for renewables is real, but the pace must accelerate. Streamlining permitting, investing in cross-border connectors, and supporting flexible backup fuels are all needed before the next crisis hits. Kadri Simpson, EU Commissioner for Energy, summed it up. We enter this winter with a healthy level of gas in storage across Europe, diversified energy supplies, a higher share of renewable energies. That foundation is solid, but it's just the beginning, not the end. And don't forget the global ripple effects. Europe's hunger for LNG has already raised prices for developing nations, who sometimes find themselves outbid in crucial moments. The drive for clean energy at home must be matched with support abroad, or the world risks new divides and new crises. So, where does this leave Europe, and what does it mean for you? The answer to our key question is both sobering and hopeful. Europe's energy miracle, keeping the lights on and factories running despite the Russian supply shock, was built on quick fixes, lots of luck, and mountains of public money. The true test is just beginning. Europe is no longer at the mercy of Russian pipelines, but it's not yet out of the woods. Its new reliance on global LNG brings both opportunity and danger. The next crisis could come from a distant hurricane, a Chinese buying spree, or a sudden political standoff. The continent has taken its energy destiny back into its own hands, but at a cost to productivity and prosperity that will take years to recoup. Yet, there's a real chance for transformation. With determined leadership and bold investment in renewables, storage, and smarter consumption, Europe could turn this era of volatility into the launchpad for a greener, more resilient energy future. The coming years will reveal whether Europe merely survives the next crisis or leads the world in building something better. One secret fact that doesn't make headlines: Europe's energy turnaround is inspiring energy reforms even in some surprising places. For example, Southeast Asian countries are watching Europe's gambits closely, racing to diversify their own energy portfolios and avoid future crises. Europe's struggle, in other words, is shaping the global playbook. What do you think? Will Europe's bets pay off, or are we just waiting for the next energy crisis? Let us know your thoughts in the comments. If you found this analysis helpful, hit like, subscribe, and ring the bell to stay ahead of global headlines. And remember,